Welcome back to Financial Clarity for Doctors, everyone. I'm Corey Janoff, joined as always by Rachelle van der Zanden.
Hey, everybody.
And it is November when we're recording this, and likely when we release this too, which is Long-Term Care Awareness Month. So we're going to talk about long-term care insurance, an exciting, riveting topic. All insurances are exciting and riveting. And by that I mean not fun to talk about, but important stuff because there's certain insurances that many people do need and that can really be of benefit to them to protect against adverse financial circumstances. So this could be relevant to some of you, maybe more imminent for some of you than others, but definitely not too early to at least develop some awareness of it to get an idea of when you might want to start thinking of it. And from a statistical standpoint, the majority of you will need some form of long-term care. I think over 70% of people at some point in their life will need some sort of long-term care, and most likely when you're older. But I think about a quarter of the people who need it are under the age of 65. So hopefully that's not the case for you, but yeah, there's a good chance you'll need some sort of assistance later in life, and we're going to dive into that and how to potentially protect against the high cost of that today, right, Rachelle?
Yeah, absolutely. I think for a lot of people that are younger, it also impacts their parents, and they see that before they ever see it impact themselves. And like the cost of care and everything like that has changed a lot over the last few decades. For those of you with older parents or parents that are kind of approaching that age, it might be something to consider for them too. Because obviously, a lot of times your parents' situation becomes your situation. And it may depend on if you have siblings, how close you live to them, and all of that kind of stuff. But this can definitely be something that affects you in multiple ways. So I think first we're going to start out just by covering some basics of what long-term care is. And then we'll talk a little bit about the insurance, like who may need it, who can probably skip it, what it looks like, all of that kind of stuff. So in terms of basics of like what long-term care is, usually it's either medical or non-medical assistance, not necessarily like help with medicines and things like that, but all sorts of assistance to help a person who can't perform some or all of the activities of daily living. So transferring, feeding, dressing, bathing, continence, toileting, all of that kind of stuff. And it can apply if you are in a facility of some kind, like a nursing care facility or an assisted living facility, or if you're at home and you just need help at home. So it can be either of those things. I think we're going to cover just some basic statistics so you all realize how common this is and how costly it can be. But one thing to note is that if you at some point are admitted to a care facility, I think there's like a 50-50 shot that you're there for over a year. But on average, like women who are admitted into a care facility last like 3.7 years in a facility, which is a long time to be there. And the average for men right now is about 2.2 years. And I think that's a lot of that is related to life expectancy and things like that. And those averages can be misleading because, there's this chunk of people that are there for longer than 5 years, a chunk of people who are maybe there only 6 months. So really, you don't know. Like that's one thing that's really hard when we're talking about insurances and we're trying to plan for these long-term things is that we don't necessarily know what this is like. But we do know that the cost of care is very high and that there is a likelihood that you will experience it at some point. The costs also vary dramatically depending on where you live, depending on what kind of facility you want to be in. I think that when we're looking at averages, you may not want to live in an average facility. If you've gotten used to a certain standard of living, you may want to be in a facility that like kind of mirrors that standard of living. You want to go through some of the average costs real quick, Corey? I feel like I've been talking long enough for a minute.
For sure. And depending on what source you look at, the statistics can vary. But and the progression, it's not like one day you wake up and you all of a sudden need full-time long-term care. Maybe if you're in an accident or have like a stroke or something, but for many people, it's a progressive thing. And you may, like Rachelle mentioned earlier, you may have seen this with your grandparents or possibly parents, where they start it's tougher to do things that they normally do during the day, and usually they don't need full-time help, but just a little bit of help, and then that's often provided by a spouse or a child. But then eventually it gets to a point where the helpers um, aren't able to provide the level of care that is needed, and you ultimately need to hire someone, maybe just part-time initially in the home. Hey, we need help in the morning getting up and ready for the day, and then in the evening the spouse or sibling can or child can help out. But then eventually it probably progresses to, assuming you keep living, to not to be morbid, but to full time in home, and eventually it gets to a point where it's not really safe or practical to be in your home, and you ultimately need to be in a facility, whether that be an assisted living facility where you can still kind of function on your own, but you definitely need the assistance, or a nursing home where you're pretty much 24/7 need some help. And obviously the cost goes up the higher the level of care that you need. For just in-home care, again, costs vary, and they can vary widely by region. If you're in a more expensive city, it's probably going to cost more than in a less expensive area of the country. But $25 an hour was kind of the averages that we were seeing. In a nursing home, you're looking at about $250 a day, or about $100,000 a year for an average nursing home for a private room. They do have some that are semi-private rooms where you have a roommate, but I'm guessing most of you listening are probably going to want the private room, would be my guess. So when we're talking the averages and average duration of stays, we're talking in today dollars, 200,000-300,000 or more that you're potentially going to be spending on that care. And that's going to increase over time with inflation, and due to population demographics. There's an increasing percentage of our population is older, and a decreasing percentage is younger. So a lot of people speculate that some of those costs of care for it's mostly older people that need the costs of care, that cost is going to rise faster than typical inflation, because the demand is just increasing more and more every single year. So those are the
Yeah.
stats for you. Now let's talk about the insurance side of the equation, or anything
Yeah,
else
and
on
we'll
that.
talk in a sec. Yeah, I don't think so. Obviously, it's somewhat depressing to think about, but it is what it is. I think that this is something that's part of life, aging and all of that kind of stuff. But there are insurances that you can potentially get to kind of offset some of those pretty enormous costs. And we'll talk in a second about like whether it makes sense to get insurance or not. But just to review some of the basics of what long-term care insurance looks like, there are a few different types, and this industry has kind of evolved a lot over the last few decades, just because as care itself has changed, as life expectancy has changed and things like that, insurance companies have absolutely had to make some adjustments to the products that they sell. But long-term care insurance is a lot like disability insurance. Disability insurance is generally designed to protect you during your working years and maybe get you to retirement age. But long-term care insurance is designed mostly for people who are not ever going to be working again, who are maybe older, not necessarily. It could be like a disability that you have somehow gotten, or like something like that. But when you are looking at insurance, we typically have to be fairly healthy to get it, just like with disability insurance, just like with life insurance. So there's going to be an underwriting process where the insurance carrier is going to look at your health. Once in a while, people have access to insurance like this through work. Not very typical, but sometimes if you can get it through work, there might be less medical underwriting or less medical review. And generally, with most products, there's going to be like a maximum dollar amount per month or per day that you can access. There may also be like a maximum benefit pool. So maybe it's like we will provide up to $7,000 per month, up to a total of $150,000 of coverage. After that, you're kind of on your own. So if you have a policy like that, it may limit the financial impact to you, but it's not going to remove it altogether. So there's definitely some financial impacts that you would need to be prepared to kind of take on yourself as well. You can also potentially get what's called an inflation rider on a long-term care policy, which means, we expect the cost of care to go up over time. So obviously, if we have an inflation rider, that will be very helpful because that monthly benefit or that lifetime maximum may increase over time as that cost of care increases. There are also some policies that are like dual policies. So they can be for spouses where, it can be a pooled benefit that you both have access to. So that way, if one spouse needs a lot of care and the other doesn't, that can be a really beneficial way to kind of maximize the benefit that you have access to. And those can be structured a few different ways. So not necessarily exactly like that, but lots of different ways that they can be structured.
And
There are a lot of, yeah, go
I was going
ahead.
to say, jumping in on the structuring, I think we've talked about disability insurance before, and many of you have it and are sort of familiar with it. It's kind of similar in that you can design these policies to meet whatever need or desire you have and to fit within whatever budget you have. Obviously, the more benefits you want, the more cost you're going to pay. But you can structure things to be smaller. Maybe we don't need to cover the entire cost of our expected care, but at least offset it to some degree. So there's definitely a policy structure out there for everyone.
Absolutely. Yep. And some insurance products are like straight long-term care policies. That's what they are designed to protect you against. If you go into a care facility, this is it. There are other ones that are like you can secure permanent life insurance, which we've talked about before. It's a bit more expensive than like term life insurances, but can have some benefits. Once in a while, you can get permanent life insurance policies that have long-term care riders. So that really is a life insurance policy. Don't think about it as anything else, but there can potentially be some long-term care benefits. Again, those are usually somewhat limited in terms of what they're going to offer you. You can also get policies that are designed to be both permanent life insurance and long-term care, which is a little bit different than having like permanent life insurance with a long-term care rider. It's like very nuanced, but the dual products are designed to be both. It's more like this is a long-term care policy, but if you do not use the long-term care benefit, there is also this death benefit that would be paid to your beneficiary if you were to pass away. So that is the life insurance component. With the straight long-term care products, most of the time, those are variable premiums, which means it may be fairly inexpensive when you're younger, but the cost will go up. And it's not just based on your age. It's based on like cost of care and things like that. So insurance companies will review the cost of care and they will increase it as needed to make sure that they can service the policies that they already have and pay benefits to the people that they already have. That was really, I think that there was a lot of time in the past few decades where insurance companies were having to increase premiums and charge people an enormous amount because the amount that they were having to pay out for their existing policies was much more than they expected because the cost increase of long-term care has not necessarily been linear. And like the number of people needing long-term care has not necessarily been linear. And that goes back to what Corey was talking about with just aging demographics, people living longer in care facilities, all of that kind of stuff.
And long-term care is a relatively newer type of insurance. Like life insurance has been around for centuries, maybe even more than centuries. But long-term care really has only been around for a few decades. And in order to run a profitable or at least viable insurance company, you need to be collecting more in premiums than you're paying out in benefits. That's how insurance works. Your car insurance, statistically speaking, you're not going to get in a serious car accident every single year, or you may get in a fender bender once a decade on average, but it's probably not going to be anything too serious. But we get the car insurance in case we're in that serious event where there's a lawsuit at hand, someone has medical expenses, things like that relating to it, and we're on the hook for hundreds of thousands of dollars. You get home insurance in case your house burns down. Statistically, it's not going to happen, but there's a chance it will happen, and that could be a pretty catastrophic financial event for you if it does. So most insurance is like that, low probability, high risk events. Long-term care, as we've learned over time, is a high probability, high cost event. So it's not like 1 or 2% of people who are collecting claims. It's like 70% of people. The other thing that these companies, or when they originally came out with long-term care products, didn't predict correctly, no fault of their own, hard to predict the future, um, is that traditionally with insurance policies, a lot of people cancel their policies before they ever collect a claim. Long-term care wasn't the case. Like people would buy policies and hold on to them, and they didn't cancel them. They would get to the point where they were collecting claims. So a lot of these companies really um, misestimated and therefore mispriced their products, and it kind of created a lot of catastrophe for long-term care companies. It started to get better where some companies have just thrown their hands up and said, we're not doing it anymore, we're out of this business. But the ones who are still in it, they've got better statistics now that time has passed, and they've hopefully priced them more appropriately, to where they're more solvent and viable, and can provide those promised benefits, for people. So
Mm-hmm.
odds are
And
people
I
are going
think
to
there
keep
is
their.
also that, yeah, yeah. But there's also a trend towards just minimizing or like, creating a cap. So if they
Mhm.
do end up having to pay a benefit, like the amount that they could pay out
Bingo.
ultimately is not going to be unlimited. And I think I've seen that with a few clients where, they have policies that are very old and they are collecting claims now, and it's a lot. And they're like, I have one person who's fairly young and very healthy, but she's legally blind and she needs assistance, and there's no maximum on her policy. She's going to collect on that claim for a very long time, for a very long time. And there's no maximum that she can collect from that policy. And luckily, it's like with a company that's been around for a long time, like they're not going anywhere. But they did not, like, count on a lot of people making claims like that. That's for sure.
Yeah, but
Yeah.
so that's the traditional long-term care. I think like you mentioned, the dual ones, Rochelle, those have become increasingly popular because one of the concerns that um, customers have when purchasing long-term care is, well, what if I don't need it? That's a lot of wasted money that I'm throwing away in premiums. Well, that's what insurance is. What if you don't have major medical expenses? Why are you paying all this money in health insurance? What if you don't get in a car accident? What if your house doesn't burn down? That's insurance for you. Expect to pay more than you're going to get back. But it's a lot of money that you're paying in. So the life insurance products, that again have become increasingly popular. It's kind of like, let's say you get $1 million policy. If you die, your family gets $1 million. If you need long-term care, maybe we need $300,000 worth for long-term care. All right, we spend 300,000 of the death benefit for long-term care, and our family gets the remaining 700,000. So it's kind of an either or, one way or another. You or your family is getting the money from that policy, but they're not cheap. Permanent life insurance isn't cheap. Um, but I think the life insurance companies, from a statistical perspective, are probably in a better position to price out their policies because they have a lot more historical data. So they know they're going to be paying out that $1 million. It's just a matter of when and whether they have to pay it at age 80 for some long-term care, or age 90 for a death. It's they know that what they're on the hook for, so they can price it accordingly.
Yeah.
Um, Anything else there, Rochelle?
I don't think so. If you are looking into products like this, do research a lot of it. Like it's not something you should cut corners on, for sure. Um, in general, I think that it's also not something that's appropriate for everyone. Not everyone needs long-term care insurance, and there's this middle group of people that I think probably need it the most. But in general, if you think you're on track to fully fund retirement and then some, you are planning on having extra money when you pass away, you may be in a really good position to self-insure. And generally, like we talk about that a lot, like if you can self-insure something, you probably should, because in general, you pay out more for insurance than you get as a benefit. Like that's how insurance companies stay afloat. We just talked about that a little bit. But if you have some other goals, like even if you think you will have extra wealth, but you want to make sure you pass that on to your family, or you want to make sure that you protect that wealth for future generations, it could still be a very good idea to look at a long-term care insurance product just to create like some asset protection. Because in reality, if you expect to have a great deal of assets at the end of your life, and you are in a position where you have to be in a long-term care situation for a long time, that is a great way to spend down that extra money. Like it can suck it up pretty quickly. So that can be a situation where maybe you're willing to self-insure, maybe you want to get some coverage just to protect that wealth, totally up to what your goals are more than anything at that point. The other situation where you likely don't need long-term care insurance, and hopefully none of you are in this position, but potentially older generations in your family might be. But if you're fully reliant on Social Security income and you don't have a lot of it every month and you don't have a lot of assets or you have very few assets, if you spend down basically all of your assets, at some point you would likely qualify for Medicaid to help you pay for long-term care coverage. And Medicaid is not Medicare. Those are two different things. So Medicare is what you are offered as an older retiree for health insurance purposes, but Medicare does not cover long-term care, or it covers like a very, very, very tiny, tiny amount. Medicaid is need-based health coverage that you can qualify for if you don't have income or if you have very, very, very little income. And when it kicks in for long-term care is if you have basically no assets, you have very little income, and it's the government stepping in to pay some of the cost of that care. So it's not for people who are in a good financial situation. Like if you're in a good financial situation, you don't qualify for that, period. Like you have to spend everything you own pretty much until then. There's some protection for like a primary residence, but that's not even guaranteed. It depends on if you could potentially go back to that primary residence, if you have a spouse living in that primary residence. So not a great situation, but could be possible, like especially for parents, if, they haven't been in a good financial situation early on in their lives, it may not make sense to look at long-term care coverage for them if you think that that's the situation they're going to be in. But if you think you're not going to be destitute, if you think you're not going to have a bunch of wealth you can tap into at some point for long-term care, that could be a good place where you're thinking that you may need to protect, some of your income as a retiree, especially, if you have a spouse, so that you're in a good position to be able to pay for that if needed.
Yep. Now, when is the right time to get it? If you think you might want it or need it. For traditional long-term care policies, a lot of companies won't offer them to people under the age of 40. So, probably your 40s would be, the earliest that you would start looking at it. But, realistically, maybe in your 50s is probably the more ideal time. Once you get into your 60s, it starts to get pretty pricey, and health issues could make it challenging to qualify for. But like all health related insurances, it's easier to get when you're younger and healthier and less expensive when you're younger and healthier. So we just have to kind of figure out what's that optimal time for our circumstances that fits within the budget and whatnot. But and depending on what type of policy you're wanting to secure, whether it's a traditional long-term care policy, again, those you probably wouldn't look at until you're at least 40, or one of those hybrid ones. You could look at that a little bit sooner because the life insurance will be cheaper if you lock it in when you're younger. Now, an interesting thing that'll be curious to see how this plays out as time goes on. There's some states that have implemented mandatory long-term care, laws or provisions where,
Taxes.
like I know, yeah, like the state of Washington is one close to where Rachelle and I are that they did it a year ago or 2 years ago. It's kind of been a mess, but long story short, they have a state provided fund. So think of it like Social Security, but at the state level, like a state pension, where they add a payroll tax, so you would have more taxes taken out of your paycheck at work, and it goes to put money into this long-term care fund. And then if you are in a position where you need long-term care, you've got some benefits available through the state provided long-term care fund, just like Social Security. Now they allowed people to opt out of that state one if they had their own private long-term care policy, and the private one had to meet certain minimum requirements. You couldn't just get $1 of insurance and opt out. So, but I know there's, I think, probably a dozen other states that have something similar in the works. I could be wrong on this. I don't follow everything closely across the country. I'm not really into politics personally, but it's funny that this has become politicized. But but anyway, so something to be mindful of. Your state may enact some sort of mandatory long-term care requirement in the near or distant future.
Hmm. Yeah, and I think that if that does happen in the state of Washington, it was messy, messy as people were trying to secure insurance so that they could potentially like opt out of that tax, especially for people who were potentially moving out of state at some point. Because if you moved out of state, as far as the Washington law was concerned, you wouldn't qualify for benefits at any point, even if you had paid into that fund. But it was hard for people to get policies and get them in a timely manner in order to qualify for that exemption. So if you think it's possible that that may happen in your state, if that's something you're interested in looking into, I would look into it as soon as you physically are able to do so, because it was quite a pain for people to try to get policies in a timely manner so they could qualify for that exemption. And again, that doesn't necessarily mean that that's something you should do, but if you want all of your options, it's something that you would want to look into sooner than later.
Yeah.
I think in general with this topic, it's one of those things where I think some insurance we talk about, it's like you need this, period. You do, like health insurance, whatever it is. Long-term care is not necessarily so straightforward. So it's something to really like sit down, figure out your goals, figure out your needs, and talk to someone about it, and start thinking about it for your parents too, because that may have a big impact on you, even if you don't necessarily expect it to. Yeah. Anything
Hmm.
else, Corey?
No, I think that's a good overview. We didn't get too far into the weeds. So let us know if you have questions about long-term care or anything else, and appreciate you listening to the show. Share it with your friends or anyone else you think might enjoy it, and we'll talk to you next time.
Thanks for listening.